Hey everyone, the virtual investor here. And in today's episode, we're going to talk about rising mortgage rates. And the question that probably a lot of people have out there is, are the mortgage rates increasing going to cause a crash in 2023? What are we looking at? What's causing the interest rates to rise? What markets are being most affected? So on and so on, right? So let's dive into it. Let's first talk about the numbers here. What's going on week over week. Again, from Altos Research is a great resource here. The inventory has again dropped this past week to 418,736, down 2.5%. Normally, we have inventory starting to ramp up. We already have had that in the past few weeks, but it's not happening this year. That's the norm this time of year. Has not happened yet in 2023. We'll see whether we have 2 or 3 more weeks of continued decreasing inventory, or whether we start to have an increase of inventory. I don't really anticipate that till March, April, May, really April, May, that we start seeing more of an increase when people start to list. But let's look at the numbers here. So pending sales are at around 59,000 right now, currently, I believe. And last year, 69,000 this week. Last year at the same time, it was 68,000. So our numbers are really similar. But remember, last year was a red hot market. Last year, we only had 241,079 houses on inventory this week. So we had less than half the inventory that we have now, or about half the inventory that we have now, maybe slightly more. And then you have a little bit less pendings that are going on there. So we still have supply issues here. We just don't have enough inventory. And that is keeping numbers up. It's keeping the median home price up. It's keeping the list price still kind of high, considering that interest rates are now at 6.65%. They continue to creep up from 6.5% last week, but not near our high yet that we had in September of 7.22. So we're going to keep monitoring that. If they get there, if they get to 8, you're going to see a huge impact. You're going to see price corrections and things come back. We're not seeing anything to kind of cause those numbers to do that. We will see, the Fed is going to continue to tighten with inflation still being a problem, and with unemployment still being low. They're going to continue to tighten. They went down they dropped rates 0.25%. They might start increasing by 0.5% again. Here we'll see what goes on for the next time that they talk about rate increases, which will happen probably in the next month or so. But that's something to keep an eye on. So again, getting back to inventory, 418,736. In January of 2019, our last normal market, pre-pandemic market, we had 819,908 homes on the market. So again, you're talking about half the amount that we have in a normal market. And that is continuing to keep prices up. And that's why you're seeing prices, and that's why they're expecting prices to be flat, maybe a little bit down and a little bit up in some markets. There are going to be markets that are affected more than other markets. We talked about the tech jobs, right? The big layoffs and all that that's happened over the past year. And that's why San Francisco has been hit. And that's why Arizona, Boise, Idaho, Austin, Texas, and even Denver, Colorado to an extent. They still got low inventory in Colorado, where the highest levels of inventory are in Austin, Texas, and they're in Arizona. And those two markets are the ones that are leading everything right now. So those markets will have more price decreases. They're going to have lower prices year over year, starting soon if they already haven't. I actually believe they already do have lower prices year over year. And again, it's just a basic macro number here, macroeconomic factor, where the prices drop when there's too much inventory. People have more choice. They can make lower offers. Pretty simple as that. So until we get that in these other markets, there's signs that maybe Florida and some other markets will have that in the near future. Certain areas around maybe Orlando, where inventory is creeping up a little bit more, but it's still really low in most of Florida. So that's keeping the prices kind of stable as where they are now. So we'll see what goes on there. But South Carolina, North Carolina, Tennessee, those markets are still really low with inventory, and the prices are still flat or climbing slightly. We're not going to see a huge increase in prices. We are seeing them year over year, still up a little bit. which is pretty interesting considering last year 3.25% interest rates at this time, and now we're at 6.65. So basically doubled them, and we're still seeing prices go up, which means demand is still there, and affordability, I guess, to an extent, is still there. But eventually, that's going to dry up. And again, if rates get to 8%, I think we'll see a sizable correction. If they get beyond that to 9 or 10%, then you're talking about 10, 15, maybe 20% correction in some markets. Every market will be affected at that point because it's all about affordability. I just don't anticipate we're going to see that. There's nothing to show that the rates will go up that high. I think the Federal Reserve would really reverse course if that started to happen because they don't want a complete collapse, but they may be too late to start that, and it may already have begun. We will see. But as of right now, I'm still hoping for that spring surge. It's probably not going to be as strong as I thought it was because I thought we were going in at 5.5% and 5% interest rate, which really would have sent a nice surge in there. Not happening yet. And we're still early. We're only at March 8th at recording this video here. So we still have a couple, 2 or 3 more months to see what the rates do. And if they start going back down, we'll get that surge. If they continue up, we won't get much of a surge. We will have our normal market where we'll have people buying and selling, obviously, but it won't be that burst, and you won't see really any price increases. At some point within the next month or two, if rates continue the trend that they're on, we're going to start seeing negative year-over-year returns. In other words, we'll have to start seeing 1, 3, 5, 10% drops in the market. So keep your eyes on that. We will see where it goes, and I will catch you guys in the next episode.